A new financial crisis has developed recently in America, says stock market expert Matt McCall. And the trail of destruction it could leave behind will look nothing like what you might expect. In fact, McCall warns nearly 40% of the elite, publicly traded companies, brands you've known and used your whole life, could go bankrupt because of a strange market event he calls the flippening, wiping out thousands of investors' fortunes. McCall has written a brand new report explaining exactly what the flippening is, how billionaires are already profiting from this big event, and what you should be doing to prepare as well. To get a copy of his new free report with all the details, simply go to stockmarketflip.com. Again, that's stockmarketflip.com for a free copy of our report. Hi, this is Daniela Camboni, and welcome back to the Daniela Camboni Show here on Stansberry Research. Well, it's shaping up to be one of the most important weeks of the summer with the Fed meeting, GDP data, and earnings from almost a third of the S&P 500 on deck. Here to help us navigate it all is Carter Braxton Worth. He is CNBC's chart master and the CEO and founder of Worth Charting. Longtime fan here. Carter, welcome to my show.
Thank you for having me. Thank you very much.
Well, it's, like I said, a very busy week. Before we get into all the charts, I want to first get your take on, what data points you're specifically going to be looking at. How about the GDP and a possible signal of a recession?
Right. So in my case, I specifically and only look at price action, which you know, and I know that GDP is an important thing, but it's all very much in the past. And in the sense that we know that the market has anticipated this slowdown by virtue of the fact it's been going down all year, whereas the data is only just starting to get questionable at the consumer level, at the tech spend level, and so forth. So I don't suspect that GDP print itself will have much bearing, whereas the Fed surely the big earnings coming up.
Right. So we're speaking ahead of the Fed meeting, 75 basis points likely on the table here. What are you expecting? Where does the Fed go from here?
So I think the market is already sort of moving, just as it was ahead of them one way, it's invariably ahead of them the other way, as they're getting, in principle, more hawkish and some talk of 100 basis points or 75, 2 or 3 times. We know that oil has already dropped from 130 a barrel to 90. We know the dollar has come in. We know commodities, wheat is down 50%, nickel. We know rates have cooled from 3.5 to 2.75. I think the market's already ahead of them yet again going the other way, and that they won't be doing as much as people have started to bet they will be doing.
I just want to bring up a recent tweet of yours here. You said, our thinking here and now is to press the bet. We think rates are headed lower still. Buy bonds, buy TLT. Your rationale here, Carter.
Right. Well, again, it's always and forever and only based on technical analysis in the sense that there's wisdom in price. The government knows this. They use stock prices in their leading indicator index. And for me, 32 years later, I only looked at Qs and Ks for the first 2 years. Some people, I guess, if you can't sleep, there are pills you can take. If I can't sleep, I get out a Q or K, I'm out like a light in a matter of minutes. And so it's based simply and solely on the price action. We could look at some price action here. Maybe let's do that. There was a piece put out just a week or so ago, and it was saying U.S. Treasury yields the path to 2.5%. Let's look at some charts. So this is the note in Chicago, the actual thing that's traded, the 10-year note. It has all the elements of a reversal. It doesn't matter whether you call it a head and shoulders, a cup and handle. It's that the sequence is changing, meaning when you make a new low, this time it made a new intermediate high. And if you look at it longer term, here's a little bit longer term, or even longer term, we're so far below the 150-day moving average that typically you get a counter trend move. And this is worth looking at. We know it was an epic head and shoulders top. And here's the fascinating thing, Danielle. It was a measured move. It was literally 12 points and 24-30 seconds from the head to the neckline. And that's exactly how much it drops. Almost like magic. And exactly that. And now we started to bounce. And for fun, look at the yield chart. It's the inverse. It's a head and shoulders bottom. And we got a perfect measured move. And it's already all coming in. That's why I think the market is ahead of the Fed and that rates are going lower, not higher.
That rates are going lower. When does that reversal start? Obviously not at this meeting. When do they change course for you?
Well, see, I think it's what they say, right? It's not about that they ever. The market's already built in that they'll do. They're not going to do 25. The market seems to have come to a consensus that's going to. They're not going to do 50. So if it is 75, and then they start to say, the data we're seeing is cooling, and we don't think we're going to do much more, or we don't have to be this aggressive. That's what the bond market is saying now. That's what yields are saying. Because otherwise, why aren't we at 4 now? We were at 3.5 just a handful of weeks ago. Why are we sitting here just days ago at 2.75? Because I think
so what does that mean then in terms of the fight against inflation then? Where does that go if they're going to if it starts cooling, if they don't feel the need to keep increasing rates here? What does that mean for inflation?
Well, see, inflation is already abating. I mean, there are so many ways to measure it, whether it's commodities, and some people say it's just rents. Rents are the thing that matter, or wages, right? But if you look at the CRB raw commodity index, or you look at nickel, look at copper. Copper's down 40, 50% from its peak. And all those cyclical stocks have given, U.S. Steel is down 40, Alcoa is down 50%. That doesn't really happen if it's about to be an inflationary commodity period. It's that it was a big spike, but so much of it was news related to the invasion of Ukraine. That's when wheat doubled, right? And nickel doubled, but it's all mean reverted. I just think the messaging here from the market, from nickel and copper and wheat and rates, from the message we're hearing from the strength in the dollar is crimping things, is that it's not going to be the runaway inflation that it's been.
Okay, so we've hit the peak inflation?
I think so.
Okay. I mentioned that almost a third of the S&P 500 was on deck this week. Want to get your take on the direction the S&P will head in then. I mean, lower rates should mean good news?
Well, I mean, lower rates sometimes are good for the market unless you're in a depression, and lower rates are not good, right? It means that something is terribly wrong. Let's look at the sequencing. Maybe we could do this if it's productive and helpful. Why don't we do 3 time frames, sort of short term, very short term, and look at sequencing. Sequencing is very important in any data series. Then let's do intermediate, let's do long term. Here we go for fun. First, the market in its wisdom. Think about the next 3 lines and columns that are going to come in. We know on December 15th, right, that the stock market, as measured by the Russell 3000, the broadest aggregate we have, was down a mere 3.4% from its 52-week high. But look at the internals. 50% of all stocks in the U.S. market already lost 20. It's a classic example of the market being ahead of the facts. The index is a weak form of analysis. The strong form is looking under the surface. So let me make that point, I think, as emphatically as I can. How do I look? I seem okay, right? I'm pretty put together. You have no idea whether I have diabetes, high blood pressure, gout. Meaning when you go into the doctor, you don't just look at the body and say, you go and do the checkup. They look under the hood. And under the hood, this is the inconvenient thing for Wall Street. Everyone in December 15th, every sell-side firm is raising their price targets for 2022. Raising them. And the market internals were a disaster. Look at this. 50%, 1 out of 2 stocks had already lost 20% of their value, and everyone's bullish. The market was telling us it was a problem. Ready? Keep watching.
Yeah.
In March, the market was starting to drop. It was down 13. Look at the internals. At this point, 50% of all stocks had lost 30 in May, and then in June we hit what would be a fairly epic moment. You're talking about 60% of all stocks down 30%. The market's way behind the facts. The internal stocks are telling the story. But let's look at sequencing now. I think the beauty of this table, not because I put it together, has nothing to do with Carter Worth. There's just no way around it. That's the thing. These are incontestable facts. Ready for this? June 4 peak, you can see it. 4 distinct sell-offs, 4 distinct rebounds. Magnitude, duration. These are the sell-offs. Let's look at them. Here we go. On a chart. Our high is Jan 4. Our low, as of now, June 16th.
Yeah.
Let's play the movie. 4 drawdowns. 1, 2, 3, 4. 4 ricochets. 1, 2, 3, 4. So here's the first drawdown, 12%, then 10, then 17, then 12. Let's look at the ricochets. Then we jump 8, then we jump 12. So here's the thing. Sequencing actually suggests now that this bounce is over. It's been very sort of on schedule, but bounces, we're going into earnings. Earnings will resolve this if and as they aren't as good as thought or feared. Apple comes up lame, or Microsoft. Remember, the top 5 stocks are 40% of the NASDAQ 100 and 22% of the S&P. We've heard from Tesla, but we got 4 more to go, plus Facebook. My thinking is we've expended a lot of energy on the sequence, and that we probably hit our head. But that's very short term, Daniel. For fun, let's look at intermediate term. And then we'll do long, and then we can go on anything. Now, do you see those lines? I know you do. There's nothing there. But they're perfectly they are mathematically parallel. You guess what that is? That is the S&P. Take it away, put it back, take it away, put it back. So our peak is October of 2007, and we go into the financial crisis. Now, one could say these lines are arbitrary. You just drew them to be convenient. I didn't. Watch this. You start with this. You connect your lows. You copy and paste and do a parallel mathematical line. It goes, we blew out through the top with the excess and then put in an absolute midpoint. We've sold off 25% to the penny to the midpoint of the entire 2009-2022 channel. And so the real question is, are we finished and it stops here and goes for more? Or does the sequencing, that bounce we've just had, start to suggest this part's over and that we are going to ultimately get down into the lower band of this 2009-2022 channel? That's my thinking. And let's look at a really long-term chart to maybe make this case.
Yep.
Here we go.
Yep.
One more. So, now this is fun. This goes back all the way to the 80s. And there's nothing on here, right? You can see no judgments, no lines. Watch this. There's your 87 crash. Take it away, put it back. What if one were so lucky, brilliance or just dumb luck, to have bought the market on that Tuesday after the 87 crash, the absolute low, and then sold out in March of 2000? Just imagine. And then stayed away and bought on the absolute low of March 6 of 2009 and sold on this year of Jan 4. Now take a look at this. Do those look identical? If you were to buy on the absolute low of 1987 after the crash and sell in March of 2000, the dot-com peak, and you didn't touch it for this entire waste of time in the middle, and then you bought on the absolute low in 09, March 6th, and you sold Jan 4. Do those look symmetrical? Check this out. They're identical.
That's crazy.
12 and a half years,
Yeah.
12 and a half years. Okay, now watch this. They're identical in magnitude. Not like sort of like one was up 600, one was up 7. Identical. Each up 620%. Okay, keep going. Then we have the fallow period. And the fallow period is 8 years, 9 months. Now here's the fascinating thing. We're going to talk about why I think we're going into a fallow period now. But there's a third one of these. Count back for fun, which I didn't even include on this deck. We know that the 73-74 bear market was a 50%er, right? Let's say one was so genius or dumb luck to have bought in January of 1975 after the entire 73-74 50% bear market and bought on the low Jan 1, 1975. What's 12 and a half years from that point? Well, 75 plus 12 is 87. Plus, if it's exactly 12 years and 9 months to the 87 peak. 3 times we've had this. 3 of them. Now, some people believe in daily cycles. We know that. The tide, the moon, monthly cycles. Some people believe in biblical cycles. It doesn't matter what you believe. There's an inconvenient cycle here that there's no way around this. And what we know, let's just do this now. We've had a bull phase, a bear phase, a bull phase. And that's not even including the one I was mentioning prior. And basically, the nominal return, and it just shows support, versus the real return. And I'm going to stop here. I just think we're headed into a fallow period. It's just not the kind of environment that's going to be, hey, we just get paid by the market, guaranteed. And that's what it's been.
Well, you definitely just made your case. It's interesting. It's incredible that the magnitude exactly the same.
I know. You almost wonder whether I play with the numbers, but I didn't. It's crazy. And that there was a 12 and a half year period before. So again, 73, 74 crash, you go 12 and a half years, 87 crash, you go 12 and a half years, dot-com crash. I mean, now some things, oh, this is numerology, astrology, this is ridiculous. Forget about what it is. It's a fact, right?
So that said, I know you don't give financial advice, but what is an investor to do here? What would you be looking at?
Well, I think in an environment like this, you want to have higher cash than normal. And I think you want to have, and maybe we have this, gold. Right now,
Sorry,
let's
did
talk
you
about
just say gold? Okay. Did you just say gold? Okay, yeah.
Yes, I think you can.
Let's talk about
Yeah.
gold. Let's
All right, let's
indeed
talk
talk
about gold.
about gold.
All right, let's have some. Yeah, go ahead, you go.
Okay. Can you tell I'm getting excited? Okay. Help us understand, given, gold is supposed to be the ultimate inflation hedge. We have inflation over 9% as we're speaking. Yes, we have a very strong US dollar. So the demise of gold, or the doldrums it's suffering right now, is it really just a dollar play card, or is there something more at play, is my question.
Don't know. I know that all commodities are down and gold's down with commodities, although gold's been going down longer, 5 months, versus commodities, which only started cracking in the last 4 to 5 weeks. But I guess the way I would, at least the way I think about it, is that there are only three, if you think about it, this covers the whole universe. There are only three sets of people, three groups. There are people who will never own gold, have never owned gold, will never, have never, meaning they just don't want to do it, right? They don't want to have anything to do with it. They think it has no yield, it has carrying costs, it's a lousy business. Even that thing they say, the barbarous relic, or the jokes about, you spend all this money to dig it out of the ground and find it, and then you go bury it back in the ground in a vault. Okay, so one group of people worldwide will never, can never, okay. And we know the opposite of that group. There's another group. They've always got it. They're gold bugs. They think whether it's end of world or they want it always a hedge. And then there are the people who are sort of willing to use it as a hedge. And what I thought we could talk about is, and this table addresses this, right? Let's talk about that part, the hedge, and then let's talk about why one should always have it. So I'm definitely not in the group that want, okay. So, and this table, I like this table too, not because I made it, but I think the colors are nice, the columns are clear, but also because there's no way around it. I mean, George Soros can't get around it, and Danielle, you can't get around it, and I can't get around it, which is to say, nobody can. And so it's very straightforward. This is the date of the high of every single 20% plus sell-off in the S&P, the date of the low, column 3, the return of the S&P, and then gold's return in the exact same period. And then, of course, the final column, which is there's no way around it. So as a simple hedge, it's stood the test of time. It is, right? It is known to be, and column 4 depicts it with but one exception, that in every important drawdown in the history of the equity market, gold during the exact high to low of the drawdown has done a damn good job as a hedge.
So you're saying even if we're down today as we're speaking, it's still doing much better than most of the assets out there. And just as a side note, I think it was the first time on mainstream media when I was watching you where you were really making a case for gold that I had never seen before. This was about 3 months ago, where you were saying, hey, folks don't realize that gold has basically lapped the S&P.
Mm-hmm. Yep. And it's look, I know that, look at the people said, well, it's passé, or Bitcoin changes. It's the only one. It really isn't a commodity either. That's the thing. It is a store of value. It is a currency. And it's, of course, the one you can't get any more of, right? Whereas they print the rest of this stuff forever. It's, but okay, now what about the other? People say, okay, fine, but that requires timing. I'm not a hedger. I couldn't. But what about the case to always have it? So watch this. This is fun. This is the .com peak. This is the S&P on its own from the absolute high in March of 2000. Well, how about this? I put in with total return, almost double, right? Dividends are important, the green line. What about gold since then? Now check that out. Gold,
wow,
forget about the S&P. That's incredible. Gold has blown away the S&P with dividends reinvested, where most people don't reinvest their dividends. And think about that. That's going back to 2000. So then beg the question, how long does one have to go back? It's 1998, where gold has paced with dividends reinvested the S&P. So that means in principle, What, that's 24 years. If you come out of college when you're 22, anyone who's 45, 48 or younger, they should have had gold the whole way. I mean,
So then
it's an
why is it
investment.
why is it a niche? Why is it seen as a niche asset then? Like, I mean, why isn't it embraced by Wall Street?
Well,
Why
some
isn't it
big
given the
firm,
street cred? Look at the numbers. It speaks for themselves. Why?
right? But I mean, here it does. And here's the ultimate thing. So Wall Street they're big firms, right? They're big players. Who's is it George Soros or pick your person? Who's the biggest hedge fund, or who's Ray Dalio or Jim Simons or Renaissance? What's that compared to governments? It's a teeny little thing. What do all governments store? Two things. They store oil and they store gold. And that's it. I mean, forget about the wheat mountains and the cheese mountains that come and go. There's a reason for that. And it's because if it really ever gets end of times, and that never is going to come, at least not in our lifetimes, right? The world's going to freeze or it's going to turn into a ball of flame. The two things you will need is a currency that you can count on, and gold is the only one, and you will need some form of fuel. And that's it. And there's a reason that governments store them and nothing else.
Do you have a preference in terms of exposure to gold? Is it physical gold? Is it ETFs? Is it the miners? What kind of exposure?
Well, I kind of do it all. But I mean, some people, if you really are in a gold phase where gold comes to life, you always want to have operating businesses, right? Because they've got gearing, they have leverage. So gold stocks will always and have done much better in a period of gold strength than the commodity, than the bullion itself. But long term, I mean, I just, I trade the futures and I roll. And I also have physical, and then sometimes I'll see an individual equity that looks particularly good, a small GDXJ type thing, or play the ETFs. But I think it's all fair game. And I think again, if you think about it, there are three categories. There's one you don't want to be in. Never own it, won't own it, don't talk about it, close my ears. You can either be in the long term, hold it, or trade it as a hedge. But just to never want to talk about it and be blind to it, it just doesn't seem informed to me.
So, I don't know your thoughts on the cryptocurrencies, on Bitcoin, but, there's huge debate between the gold camp versus the Bitcoin camp, and the Bitcoiners would say, well, why would you own gold when Bitcoin is just a better version of that, and that's the future? I mean, I'm just curious to know your thoughts on Bitcoin, and, this debate out there of gold versus
Yeah, I never understood it. I mean, in the sense that I've only heard of gold, right? I didn't hear schmold or nold or cold or bold. How many cryptos are there? There's only one gold. There's Ethereum. I mean, it goes on and on and on. And gold doesn't have 70, 80% drawdowns. It's just a totally different animal. Maybe perfectly legit. I've bought and sold crypto a bit. I don't understand it, to be fair. People say blockchain's very real. It's not about that. For me, it's always just a trade. But there cannot be any notion that somehow gold and Bitcoin are comparable assets. That's dead on arrival. Gold doesn't get stolen on the internet and, I'm missing my 2 billion in crypto. I mean, none of that is,
I guess if I had to really sum it up, you're basically saying, look, I'm happy with gold's performance. I don't know about the USD strength weighing on it. And frankly, I'm sensing it doesn't matter to you, because you're basically saying it's doing its job.
It's done its job during the crisis. And here, we can draw some lines together for fun. We know it got right to the former high, and some people would call that a double top. We know it's drawn down right to the low. It's been in this range for all of 2020 and all of 21 or 22. And look, one's a 19.2% drawdown, one's an 18.8, right? You put these charts together, there it is. You do it a little longer term and then put in the trend line. Gold broke below its 5-year trend last week and then was able to recover and get back above it. It's pretty important here that it doesn't get a lot worse than this, because you're allowed to draw down, 18, 22. When you start drawing down 30 and 40, you've got a big problem. My hunch is it's okay, and one wants to stick with it.
The naysayers would say, looking at a 10-year chart, they would say, well, the gold price has done nothing. It's done utterly nothing.
Mm-hmm. Right. Well, I mean, that was the point of showing you some of the longer term charts of gold relative to the market. One could say, well, what has gold done relative to equity since 2000? And we know the answer to that. We just showed it, right? Everyone has their cycle, every commodity or currency, and everyone has their good and bad moments. But the question is, I guess I would put it this way, is this 19% sell-off, plus or minus, is this the beginning of something really bad, or is it still normal or normative within the context of a strong dollar, a recent collapse in all commodities, and that you do get pullbacks? I think it's still normal.
Yep. Well said, Carter. And if you don't mind, if we could fire in a USD chart, just curious to know your thoughts, and specifically a US dollar versus the euro. Many folks think the US dollar will keep marching higher and the euro will keep marching lower.
Right.
But from analysis I've seen of yours, you think otherwise.
I think they're pretty stretched. So it's, again, always knowing what your time frame is. We all have different times, and you're allowed to move between them, but you're either short term. On a short term basis, the spread is just too wide. So this was a piece put out a week and a half ago, and you could see it's very straightforward. Two colors, two lines: dollar and green, euro. That's a 6-month comparative. That's an 18-month. That's a 24-month. The spread is just too wide. And the reason we've gotten the mean reversion, not because I say so, it's just that that's what happens when you get certain number of standard deviations too far one way. And this is a 5-year chart. It's very extreme, right? Now here's a 10-year. Now, again, just showing about what your time frame is. Here's 15-year, but then here's 20. So now what do we do? Wait a minute. 15, it's stretched, dollar versus euro, but 20, they're even money. So is it stretched? It's just about the here and now. The here and now charts, the euro is way overdone. People like the phrase oversold or overbought. That's fine, whatever phrase, using oscillators, however you want to do it. But is it overdone on a 20-year basis? No. And so I guess the point is it's knowing what time frame you're playing for, what your price objective is. On an intermediate basis, there's 30 years, and there's all data. Look at that. Doesn't look extended at all. So I guess the point of this piece, and this was actually when it was done, and we're pleased with this because the dollar is sold off nicely. Dollar's too far above trend, euro too far below. Now that mean reversion has started, Danielle, as you know. Frankly, I don't know how much more dollar give back there is, but we're just sticking with this trade for clients just 2 weeks ago.
Wow. Well, you've just brought us just a wealth of information. I mean, like I started by saying, we're leading one of the busiest weeks of the season here in terms of earnings. I mean, do we want to pull up Apple or Alphabet and just get your thoughts on those quickly?
Sure. And some of this stuff here, watch this. Let's do Apple. So just what you said, we have the top 5 stocks representing 40 when we've heard from Tesla. And of course, it used to be Meta. Now just fallen from grace, down 50% Tesla's there. Here they are, they're 22%. 4 of them report the top 4 this week. And if you were just to look at Apple alone, which is the biggest, look at this. It is trend line to the penny, to the penny, to the penny, to the penny. And then when you break trend, often you'll throw back to the underside. And look when it kicked back and it hit the line and died. And we're right there again, which is also where the 100-day average comes into play. My hunch is that Apple, up 22% off its low, double the S&P, up 10 since its June low, has expended a lot of energy, and that there's more downside risk post-earnings than there is upside potential.
Carter Braxton Worth, I just had a blast today.
Thank you. Well,
thank you for bringing all these charts. I loved it. It was really informative. Thank you so much. And how's your summer going?
It's great. And yours? I'm out in Long Island in Bridgehampton, New York, and enjoying it. It's a good time to sort of get away from some of the fast goings of New York City.
I don't blame you. I do not blame you. Well, I'll come back anytime. Thank you so much. And thank you all for watching. We'll have much more coming your way as part of our summer series. And don't forget to sign up at danielacamboni.com so you can stay up to date on all these awesome interviews. That's it for me. Thanks for watching.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.